Hello! Today we're going to be discussing the units of production depreciation method. The advantage of this method is that it records more depreciation expense in the years when the asset is used more frequently. So I have a couple of formulas here that we're going to be using as we complete this problem, but first let's read what's going on. So it says on January 1st, 2009, Mr. Ed's Consulting Services purchased a company vehicle for $25,000 with an estimated 4-year useful life and a $3,000 salvage value. The company estimates that the vehicle will last for 100,000 miles. We are asked to calculate the depreciation expense, the accumulated depreciation, and the book value for the 4 years of the vehicle's life. And we're going to do that in this chart that I've created over here on the left. So the first thing we should do is to copy down some of the important information. We are told that the company vehicle was purchased for $25,000. So that means the cost is $25,000. They also tell us that the salvage value is $3,000. So that's the amount they think they can sell the vehicle for after its 4-year life. The total units here can be viewed as the total miles that the company estimates they will drive the vehicle for, which is 100,000. And now we can calculate the depreciation per unit using this formula here. So that'll be the cost minus the salvage value divided by the total units of production. So our cost is 25,000 minus the salvage value of 3,000, and divide that by the total units, which is 100,000, which gives us a depreciation per unit of 22 cents. So that means for every mile that the company drives, they will record 22 cents of depreciation expense. The next thing we can do is calculate the depreciation expense for each year. And we'll do that using this formula, where depreciation expense is equal to depreciation per unit, which is 22 cents, multiplied by the units produced in that period, which in this case is going to be the miles driven. So for year 1, we take the depreciation per unit, which is 22 cents, multiply that by the 30,000 miles, which gives us a depreciation expense of $6,600. We can do the same thing for year 2, take the 22 cents, multiply that by the 35,000 miles driven to give us $7,700. And you can do the same process for years 3 and 4, and you should get $5,500 and $3,300 for years 3 and 4. Next, the accumulated depreciation is just the sum of all the depreciation expenses up until that year. So the first year, the accumulated depreciation is always equal to whatever the depreciation expense was in the first year. So we can just copy that one down. The second year needs to add up the first 2 years' depreciation. So we take $6,600 and we add that to $7,700 to get $14,300. The third year we have to add up the first 3 numbers, but we already know the $14,300 added up the first 2 numbers. So I'm just going to start there. $14,300 plus $5,500 gives us $19,800. And then we can do the same thing for year 4. $19,800 plus $3,300, which gives us an accumulated depreciation of $23,100. Next, we can calculate the book value by taking the cost and subtracting the accumulated depreciation. Well, we know the cost is $25,000, and we just calculated the accumulated depreciation in the last step. So year 1, we can take $25,000 and subtract $6,600 to get a book value of $18,400. In year 2, we can take the cost of $25,000 and subtract the accumulated depreciation of $14,300 to get a book value of $10,700. And you can do the same process for the remaining 2 years. You should get a book value of $5,200 in year 3 and a book value of $1,900 in year 4. Now you might be noticing a small problem here, and that's that the salvage value is $3,000, but the company has depreciated the asset down to $1,900, which is lower than the salvage value. So you can never depreciate an asset below its salvage value, so that means we're going to have to modify the last year. So I'm going to delete all of these numbers. And what you end up having to do is taking the salvage value and replacing that with whatever the book value was. So just put the $3,000 as the new book value. Next, go to the depreciation expense and take the difference between the previous year's book value and the salvage value, which we just replaced here. And that tells us that the depreciation expense needs to be $2,200. Next, we can calculate the accumulated depreciation just like normal by taking all of the depreciation up to that year. So that's 19,800, which is the first 3 years, and adding that to the last year's depreciation expense, giving us an accumulated depreciation of $22,000. Alright, we are finished with the calculation of the depreciation expense, the accumulated depreciation, and the book value for the 4 years of this vehicle's life. Now there are just a few things I want to note here. One is, the reason why we had the book value go below the salvage value when we initially created this chart was because the total of the miles driven ended up being more than the estimated number of miles. So if we were to add up all of these numbers here, we'd see that the total miles driven was actually 105,000 miles instead of the 100,000 which was the expectation. And that's the reason why we had to make that adjustment in the final year. The other thing is that you can do the units of production for many different types of assets, not just vehicles. The most common example would be for a machine, which is actually producing units of product. So instead of having the depreciation per mile, you could have a depreciation for each unit that a machine was to produce.